Hello and welcome to this edition of All About Your Company. I'm Harsh Saita. Today we're going to be talking about a logistics player, and why? Because it's given 0 returns over the last 5 years. Could we well be in the midst of a turnaround? Point number 2, you've got West Asia. What's the impact of that on the business? We'll try and understand all of that and more. And it trades at a 30% discount even to its 5-year average valuations, and therefore doesn't look badly priced either. So, and we'll try and get a perspective, of course, with regard to forward guidance. We'll have Mr. Samvid Gupta joining us, who's the Joint Managing Director at Gateway Distriparks. But let me go right off the bat and try and explain what the company does. It was incorporated in 2005, has a market cap of around 2,800 crore. It's an Indian logistics player. Rail-led multimodal logistics is what it does. Inland container freight depots is what it runs. Freight stations, warehousing, road transport services, even cold chain facilities. It does all of that. It's part of the Gupta family promoted Prism International entities. Now let me try and break the business down. Services coming on your screen in just a minute, but I'm going to try to break the business down. What it does is it tries to help importers and exporters. So rail transportation services, EXIM. It's basically from factory to the hull of the ship, ensuring that all of the paperwork and all of the physical transport is taken care of by Gateway. That's essentially what it does, and that's around 70%, around 3/4 of its business is exactly that. From the factory floor till the hull of the ship, cleared for export. And basically it's one of the only private players that does this in such a significant fashion. So that's one. Second, it does storage, of course. In between all of this, there is storage which it does transport, it does custom clearance, it helps its customers do all of that. It handles rail, it handles even road transport, for example, from factory till the rail yard, from the rail yard loading it up onto the railway. All of that is generally what it covers, and it does around 20% margins on the business that it does. In fact, 20% plus margins on the business that it does. I'll just quickly cover each of these. What is rail transportation, export import, which is moving loaded containers between factories, depots and ports. Rail transportation domestic is moving containers between inland depots within India, say from West India to East India. If there is some supply which is required, it takes care of it. Some of the railway, in fact the wagons etc., are owned also by Gateway Distriparks themselves. Some of them are leased, but a lot of them are owned. It's one of those very niche players which actually owns some of these railway containers. What it also does is inland container depots, which is rail terminals offering custom clearance and storage. So an inland container is nothing but a custom clearance port which is not at a port, which is inside in the hinterland, and therefore does not waste space at the port. Very convenient for exporters because they can actually custom clear their product inside in the hinterland itself, and thereafter send out the goods which go directly into export and don't need custom clearance at the port, which is generally extremely rushed and extremely crowded, and therefore that delay is not something that some of these products or goods face. Warehousing, well, of course, safe warehousing of cargo depending on timelines of when it needs to get exported. Road transportation, they have trailers which carry containers between customer, depot, port and the like. They also have container yard operations, which is within a container stacking, within a container yard, stacking containers, empty containers, unloading, loading and the like. You have value-added services, packaging, labeling, consolidation, special handling requirements. And then there is Snowman Logistics. It owns 50% of Snowman Logistics, a majority stake, 50.01%, so just about a majority. And Snowman is unique in its proposition because it provides temperature controlled storage for food, pharma and other sectors, but food and pharma predominantly, and this is obviously a very large market in India, but it's not something that has been fully penetrated yet, largely because of a lack of such facilities available. But what Snowman has actually done is it's gone also into dry warehousing, which is not cold storage itself, and therefore margins have come off. In order to gain market share, they are doing dry warehousing. So there's been a bit of a shift. There's a turnaround required in that business. We'll get a sense as to whether that turnaround can play out or not. They also run refrigerated trucks, by the way. So that's the other piece. So if I were to simplify this business, three verticals. One is transport and freight terminals, and transportation even from the rail yard, from the factory floor to the rail yard to the port, port out, right? Road transport and rail transport. Then there is also a lever of dedicated freight corridor, which is also very interesting because a predominant chunk of the revenue is rail related. Dedicated freight corridor will ensure that double stacking will happen. Currently, only single stacking happens, which is only one container on each train. Now with double stacking, that means that you'll have even better optimization, which will likely play out. And Gateway District has a very, very large exposure to that if it were to play out. Of course, some elements of that dedicated freight corridor need to be completed for this to play out, but it could well be a massive positive. Now, let me talk about numbers. 10 container terminals is what they run. Inland container depots in terms of locations are Gurgaon, Ludhiana, Faridabad, Ahmedabad, Kashipur. Indore is still under construction. Jaipur land acquisition is also underway. So we'll ask them with regard to some of those moving parts as well. Container freight station locations are Nhava Sheva, Chennai, Krishnapatnam, Kochi, Visakhapatnam. So they have exposure as well as they have access to all of this through their rail as well as road transport networks. Revenue drivers is fees for logistics is what they make. What they invest in is rail-linked inland depots and trains. Double stacking should obviously improve and drive profitability higher. I did explain that. And then there's cold chain business, which owns and leases temperature-controlled warehouses, storage plus distribution, especially used in food and pharma. We've kind of tried to cover this whole business, of course. Now let me try and get you the financials and give you a perspective as to how numbers have moved. You'll see in terms of top line growth, we've seen a boost in FY26. From FY25 onwards, you have seen a consolidation of, excuse me, you've seen a consolidation of Snowman also into the numbers. And we've seen a boost in terms of FY26 top line, which has played out. But what has not played out as well is the EBITDA. EBITDA has largely been stagnant. There's been a 9% growth rather, and profitability has been literally 2% CAGR. So that's where the problem seems to lie, at least at this point. It's a 3-year CAGR, even though we're showing you 5-year data. It's the 3-year CAGR, last 3 years, in terms of all the numbers. So just bear that in mind. So that's with regard to that's with regard to the top line as well as the P&L account. Now let's talk about the margins. And operationally, it does 20% plus margins, but it's come off. It used to do 27%. It's currently at 22%. I wonder if it goes back. It's tough to believe that it will go back to that 27% mark. But if we were to revert as scale picks up, to what extent can it go back really? That will be my question. The third piece is with regard to the balance sheet. And you'll see the balance sheet currently, it trades at a price to book of nearly 1.3 or 1.4 times. So it's not very expensive from a price to book standpoint. 2,300 crore is the book value currently in FY26. And you've got borrowing which has come off from the highs from a couple of years ago. Let's quickly pull up that borrowing number. It used to be at 430 crore in FY23. Currently sits at sub 300 crore. It's got cash bank also for around 20 crore. It has investments as well, something that you should factor in. So around 100 crore odd of cash bank plus investments is what it holds. Cash flow. Again, the cash flow conversion is very, very healthy. There's no concern there. So we're giving this a thumbs up, clean. Balance sheet also thumbs up. Cash flow also thumbs up. Return ratios. This is again where a possible problem could arise. You're not seeing 15% ROCs. You're seeing maybe 12, 13%. But you have to contextualize that the valuations to reflect this. So that is something that you want to bear in mind. We've given this a neutral, but you want to bear that in mind, that valuations at maybe 10 times earnings aren't particularly expensive either. And therefore, the ROC not being too high could well be tolerable, at least at this point. What we're seeing is, in terms of shareholding, 34% holding by the promoters. It also holds 50.01% in Snowman Logistics, which is a listed company, 600 crore in market cap. Trades at 150 times earnings, but the profit base has eroded sharply. So just bear that in mind. Broadly, this is the structure of the current shareholding of Gateway Distriparks. I did describe the shareholding of Snowman Logistics as well. In terms of analyst coverage, and this is where it gets very interesting. You've got Jeffries, you've got Kotak, all of them covering this one. 8 buy calls, no holds, no sells, and the upside is 54% on this one. Yes, I repeat, 54% upside is what the average analyst recommendation seems to suggest. A very strong upside is what analysts seem to be penciling in on this one. Valuations, and this is probably where the key part of the reason for the upside looks like. 10 times 1 year forward earnings is what this one trades at. The 5-year range is 5 to 21. 2022 was when it was at 5 times. There was a crisis back then as well with regard to logistics, and that's why it used to trade at 5 times, but zoomed back up immediately post that hiccup was over. And it used to trade at 16 times back then, and the average, historical average 5-year is 14 times. So bear that in mind. Let me in fact bring on board Samvid Gupta, who's the joint managing director at Gateway Distriparks, joining us this afternoon to give us a sense of exactly what's playing out. Hi Samvid, let me first try and understand West Asia. How is that playing out on your numbers? The last call suggested that there is obviously some concern, there's some headwind there. What's playing out on the numbers, and is there an unwind which is likely, is something you're seeing?
Hi, thank you for having me on the show. So yes,
Great having you.
West Asia has had an impact on our numbers, particularly in March, and going forward, the trend is also similar right now. It's a day-by-day situation that we look at, and it's ever changing, so we can't really give a proper guidance on how much it will impact going forward. That's why even for FY27, we haven't given our number guidance yet. But on a very rough basis, 10 to 15% of our exports is towards the Middle East. But not just the Middle East, even the Europe and the Americas volume has been impacted because there's a whole shipping line cycle disruption. So we have to wait for further clarity on whether the ceasefire will continue or whether the war will end soon, and then we'll accordingly give our guidance after maybe a month or so.
Samvid, does this mean that the revenue which likely has not yet translated will never translate, or if at all there is a resolution in West Asia, this will unwind very, very quickly? How does it play out?
So there is some backlog, so that would come in. But even if the war ends today, our assumption is that it'll take about 3 to 6 months for things to normalize because of the backlog, and people starting to get their services resumed will take some time. So there would be a pain for maybe a quarter or two coming in for everyone.
No, so by backlog you mean, so uh, if things were to improve, say starting tomorrow, the backlog starts getting cleared, right? And you start realizing revenue as a result of that. Is that, am I thinking of this correctly, or am I getting something wrong?
No, more or less, but it's just that a lot of people decided to explore different markets like domestic markets or change their trade lanes. So to get those orders again from Middle East, from Western countries, that'll take some time again to kickstart. There are a lot of containers still at stabled at different ports or at sea still, which were meant for India but never reached India. So that's what I meant by the backlog. That revenue will come in as soon as this is over.
That makes a lot of sense now. Okay, understood. So therefore, FY27 looks difficult, but on a steady state, Samvid, let me take you 2 years out. Once all of this starts getting cleared up, what happens then, and what's the aspiration then in terms of the visibility and the view?
Yeah, so our plan is to keep expanding our ICD and rail network. So we already have Indore under works, which will come in by 2028. Jaipur as well, we had some land issues, but those should clear out later this year, and that will also become operational by 2028. We had signed up an asset light partnership at MMLP Ankleshwar. Their domestic operation started last year, but the ICD operations will start sometime this year. So all these will add into the existing growth that we were targeting on a normalized basis of 10-15%, plus these new locations coming in. Um, we're also hopeful with all the FTAs that have been signed and trade deals that are going on, that will further boost India's EXIM volumes and add to more than normal growth.
So you're saying 10% growth is something that one should reasonably pencil in, right? Is that something that we can comfortably say at least till FY28?
On a normalized basis, yes, but like I was saying, we have to evaluate this situation on when this war will end, and accordingly, then we'll give our proper guidance. But we're still hopeful of a double-digit growth all across.
Excellent. Okay, so let's pencil that in, and let's also try and also, if you can give us a view with regard to both Indore and Jaipur, which you spoke about, and Ankleshwar for that matter. How much should that add in terms of revenue to your top line?
So it depends. It takes time. About 2 years after an ICD is operational, it takes to ramp up certain volumes. So we're looking at it from a more longer term perspective. But this could further add, say, about another 10-15%, all three locations combined to our overall revenue.
Understood. So if you do a double digit this year and next year, and if things were to normalize, obviously subject to, it's just conjecture at this point, you'll probably do 2,000 crore of top line in FY28. And thereafter, just organically, or rather the new capacities which you're building up should add another maybe 200 odd crore to the top line. Am I thinking about this correctly? On top of the 10% to 15% growth aspiration that you in any case clock, right?
Yeah, so that's for the container business. And then on a consolidation basis, Snowman Logistics adds its revenue separately.
Right,
And we
and talk
expect
to us
their,
about,
yeah,
yeah,
sorry.
talk to us about that, because there the aspiration is to get to 1,000 crore in terms of top line. How quickly do you get there?
Yeah, I think this year we closed slightly above 600. Next year, the target is for close to 700. Consumption has been on the weaker side, but we are looking at continuing to expand our facilities, both on an own basis as well as an asset light basis, where we have people who make build to suit facilities for us and we lease them out for long term. So 1,000 crores maybe within 3 years of is possible at Snowman on an individual basis.
Okay, and that is unaffected by West Asia, right? Samvid, am I thinking of this right?
No, there has been impact of that also, because a lot of restaurants, people's productions have gone down because of gas shortages. So that also remains subdued. And once this clears up, that will also pick up consumption and lead to better volumes and numbers there as well.
Okay, but just one question. So the 700 crore aspiration is if things normalize at Snowman.
Uh, 700, I think, is doable regardless. It could possibly be maybe slightly better if things end today.
Okay, Samvid, I'm going to have to slip into a very short break. I know we're just kind of holding up the conversation. It's a very interesting conversation I'm having with you. We'll talk a little bit more about Snowman, because it sounds more interesting, at least at this point. We slip into the break, come back, try and understand Snowman a little bit better, because that's where probably a turnaround is playing out. Stay with us. Welcome back, and we're still in conversation with Samvid Gupta of Gateway Distriparks, giving us a perspective on what's playing out on the business there. Samvid, you spoke about how Snowman, in terms of top line, will eventually, in the next 3 to 4 years, go towards the 1,000 crore number. 700 crore FY27 looks comfortable, at least that's what you're saying even now, despite the headwinds. Give us a sense on what's played out. You've gone into dry warehousing. How's that strategy played out for you? How do you evaluate the way in which this has played out for you? The street doesn't really reward you for whatever's playing out. So give us a sense of that. What's your message to investors?
So we basically started a new division called 5PL. It's not exactly dry warehousing, but it's a end-to-end from procurement till collection, and sort of a trading division of ours, where we source all kinds of products for our customers, primarily in the food space. Dry warehousing, we only came out with about 2 locations, but we're not really expanding too much there. We're focused on frozen and chilled. Um, in terms of the top line growth, that's where it's kind of coming from the 5PL side, but that's a low margin segment, but it helps our warehousing and transportation margins as well. and it increases the stickiness of customers. So we started slow, but now we have five key customers there, and we're looking to expand this segment as we grow towards 1,000 crores. On a combined basis, our margin should be somewhere around 15% when we're at 1,000 crores. So we're targeting a 150 crore EBITDA when we reach there. ROC numbers have been low in the past, but we have changed the model a bit. So all our new projects have an ROC which is in double digits, whereas the company wide right now we're close to 4%. So we're targeting over time that we at least get to 10% as more and more new projects come up. Uh, but the core focus remains on the cold storage warehousing bit.
Right, and there the margins are much better. But despite that, you'll
Uh,
do 15% because you're doing 5PL. Is that the right way to think of it?
Yeah, so warehousing and transport blended will give upwards of 25%, and 5PL gives about 4 to 5%. So that's why combined 1,000 crores will probably be 50% 5PL, 50% of warehousing and transportation, giving a 15% margin.
You're at 15% currently. Do margins dip from here, say in FY27?
So we're expecting warehousing and transport margins to improve slightly as more utilization improves. Because last a year and a half consumption was weak, so our average utilization was closer to 80 to 85%. Now we're targeting about 90%. So that'll automatically improve the warehousing margins as well. We've also given up some low yield cargo and managed to replace it with better frozen and chilled, as we've converted some chambers from dry to chilled and some chilled to frozen. So that's also helping our numbers.
Got it. So therefore, your 15% margin largely sustainable. Is this the bottom, and will it therefore remain steady over the next 3 to 4 years? Is that how one thinks of it?
Yeah, we expect that.
Okay. So your top line continues to grow maybe 15 odd percent from 600 to 700 crore, and your margins remain flat, and therefore your EBITDA also grows at around 15%. So your EBITDA should therefore, and that differential should therefore flow through straight to PAT, because depreciation and interest costs will largely remain stable. Is that the right way to think of this?
Yeah, so depreciation would kind of remain in line with what we're doing as more new warehouses get added, so some might increase. But we have a deferred tax asset. So actually, if you look at our PBT to PAT, it's not like 25-30% that is the difference. It comes to about 50-55%. There's a big carry forward loss. So it's an advantage to us also that we're paying less cash tax. But in the accounting standards, our PAT looks more subdued, but it'll flow till PBT at least.
That makes sense. And talk to us about the larger group. Therefore, Gateway. On the Gateway side of things, as you ramp up towards 2,000 crore in terms of top line, how should the product mix and the split be? And what do you do with the CFS business, which obviously has very high competition, and therefore you are planning to also divest some part of it? How does that play out?
Yeah, so very roughly, the rail portion, like you said, is three-fourth of our business, and that will continue to increase, whereas CFS has been more stable in terms of both volume as well as revenue. But CFS is still giving us good cash flow. We had done an exercise to try to explore to monetize it, but now we're no longer looking to divest from the CFS segment. We had essentially reached a debt-free position a few months ago where we announced a special dividend. So we're very comfortable keeping it as well. Um that being said, if a very good valuation comes in, we can look at it on an asset to asset basis, but there's no compulsion for us to do it. So on the rail side, as we grow the margins, like we were saying, we're hovering around 24%. This might come down as we increase more domestic and more short distance volumes like Ankleshwar and Viramgam, but our overall EBITDA will still go up.
When do you expect the DFC to start connecting to the hubs which you source from? Because that will also add to that margin number that you're speaking about. In fact, it should also add to top line, not commensurately try and dent your expenses line as much, but actually add straight to bottom line, right? How should one think of that timeline and quantum?
So till Mundra Pipava Kandla, we're already using the DFC. Till JNPT, the trials are now complete. Or trials are ongoing, but the track work is complete. And we're expecting within a month or maximum 2 months that double stacking and DFC operations till JNPT is operational. till then we got the advantage of the MMLP at Ankleshwar, and we're double stacking till there. So whatever incremental benefit is in terms of speed and loadability that will come in, that will help us in our cost, and that will flow through to the bottom line.
How much? How much, Samvid?
It's hard to put a number on it, but right now, say our double stacking is at 40 to 42% average. We're expecting once this is done, we might go up to 44 to 45% average.
Okay. Thank you so much, Samvid. This has been very good trying to understand this as a business as well as speaking with you and trying to break this down. Thanks so
Thank
much
you
for
so
coming in and
much.
speaking to us. All right, viewers, out of time on this edition of All About Your Company. Thanks so much for tuning in.